The Magnificent Seven in Apple, Microsoft, Amazon, Google, Meta, Tesla, and Nvidia have dominated the stock market over the past few years. If you invested in just these 7 companies, you would have crushed the broader market. However, in 2025, things may be changing. Most of these stocks are struggling, and some are down big. For example, Tesla is down 25% in just 1 month at the time of recording. And this raises a big question. Is it time to ditch the Magnificent Seven, or at least diversify beyond them? In this video, we'll break it all down, comparing a Magnificent Seven strategy to a S&P 500 strategy to a broader global fund approach. If you're new here, I'm Finch, a management consultant by day, and on this channel we like to discuss all things personal finance with particular focus on how to grow your money through investing. So let's get into it, and let's start by looking at the case for the Magnificent Seven. If we just look at past performance alone, continuing to bet on the Magnificent Seven seems like a no-brainer. From 2015 to 2024, these tech giants returned nearly 700%, crushing the broader S&P 500's 178% return. In fact, most of the S&P's return in that period was driven by the Magnificent Seven. In 2024 alone, the Magnificent Seven accounted for over 53% of the S&P 500's total gains. This dominance doesn't look like it's going to stop anytime soon, as all of these companies are driving the future. For example, Nvidia, Microsoft, Google, and Meta are all leaders in AI, whilst Amazon, Microsoft, and Google are driving progress in cloud computing, and Tesla, of course, is driving the future with electric vehicles and automation. So surely betting on the Magnificent Seven still makes sense, right? Well, not so fast, because past performance is no guarantee of future performance. And even though it seems these companies are well positioned for the future, relying on just 7 companies has huge risks. The most obvious risk is a lack of diversification. With a Magnificent Seven only portfolio, you're betting on just a handful of companies. This means if just 1 or 2 struggle, your whole portfolio will take a massive hit. And these companies are not immune to big drops. For example, in 2022, Tesla fell by 65%, Meta dropped by over 60%, and Amazon lost 50%. It's not just about individual stock risk either, it's also about sector risk. All 7 companies are in tech. Yes, even Tesla is essentially a tech company. This means if tech struggles, they all struggle. Historically, no sector has dominated forever, so by focusing only on tech, there's a risk that you can miss out on gains in other industries like healthcare, energy, financials, and consumer goods. Another risk is around high valuations. These stocks have gotten very expensive. For example, Tesla has a PE ratio of over 100 at the time of recording. For these valuations to make sense, these stocks have got to continue their massive growth. If they don't, they could see massive drops in their stock price. However, this isn't the biggest risk in my opinion. The biggest risk is that history shows market leaders change. Although these stocks dominate today, they're the best performing stocks today, it doesn't mean they'll continue to dominate in the future. In 2000, the biggest stocks were Cisco, General Electric, ExxonMobil, Intel, and Nokia. These companies were once considered unstoppable, yet today, most of them have fallen behind. So if you're investing in the Magnificent Seven, you're assuming that these companies will continue to lead in the long term. But history tells us that this is not a safe bet, and in 2025, we might already be seeing early warning signs. This is because among the top 10 best performing S&P stocks this year, only 1 in Meta is from the Magnificent Seven. None of the other Magnificent Seven stocks even crack the top 50. Instead, mid-cap growth and value stocks are leading the market for the first time in years. And this could be the start of a long-term shift. So what's the alternative? If you want to reduce risk and diversify beyond the Magnificent Seven, then one option is to invest in a broader S&P 500 fund. Through the S&P 500, you still get exposure to the Magnificent Seven, but you also get sectors like energy, healthcare, financials, and industrials. Sectors which don't tend to move in sync with tech. This smooths out volatility and protects you from downturns in one single sector. Importantly, this index also adjusts over time, adding high growth companies and removing companies which lose value. This is because there are specific conditions to the index, such as the fact that the market capitalization of companies within it must be at least 14.5 billion. So if a company drops below that level, it might be removed. Or if a company exceeds that level and is not currently in the index, it might be added. This ensures that the index always contains the strongest and most relevant companies over time. However, there's still one big problem with the S&P 500. It's heavily concentrated. The top 10 stocks make up over 35% of the entire index, meaning if just a few of the biggest companies struggle, the entire index will take a hit. This happened in 2022 when the big tech companies declined and pulled the entire S&P 500 down with them. Fortunately, there is a way to overcome this concentration, as investing in an equal weight S&P 500 fund gives equal weight to all companies in the index. This reduces dependence on big tech and gives more exposure to other sectors. However, even with an equal weight fund, there are risks, as it's still fully focused on US companies. And this raises the question whether there's a need to diversify beyond the US market and invest in a global fund. You may ask, why is there a need to invest beyond the US market, as this is the best performing market in the world? But the US stock market might not dominate forever. Right now, the US makes up 60% of the global stock market, and for the last 14 years, the US has massively outperformed non-US markets. If we compare the S&P 500 versus international markets over the past 10 years, we can see huge US dominance. However, over the long term, history shows that international markets can outperform too. For example, in the late 80s, international markets outperformed, led by Japan. And in the early 2000s, international markets outperformed again, driven by the emerging markets. The current cycle of US outperformance is over 14 years, which is already beyond the historical average of 8 years. This suggests we might be overdue a period of international outperformance, and in 2025, we may already be seeing the start of a shift, as so far this year, European markets have dominated. The European Stoxx 600 is up by over 8% this year, whereas the S&P 500 is actually down. It's down by over 1.6%. We're only in March, so a lot could change for the rest of the year, but the initial signs say it could be the year for European markets to dominate. And with a global index fund, you get exposure to European markets to benefit from that growth. Global funds, like the FTSE Global All Cap, tend to have exposure to the US, Europe, Japan, emerging markets like China and India, Australasia, and more. So if US stocks keep dominating, you still benefit. But if the US underperforms and other markets perform, like Europe, you're protected. By holding a global fund, you don't have to guess which companies, sectors, or even countries will dominate next, as you own them all. In conclusion, which strategy is best? Well, that depends on your own preferences, your own risk appetite, and your own strategy. If you're a high-risk investor, then a Magnificent 7 only portfolio may still lead to high returns, but it may also lead to high volatility, and it faces the risk that history repeats itself and the market leaders change. If you want a more diversified approach, then an S&P 500 approach may work. And if you want maximum diversification and global exposure, then a global fund may be the one. For me personally, I'm focusing on a global fund. I do still believe in the S&P 500, and I believe in the majority of the Magnificent 7 companies. However, the index is just too concentrated on a few companies for my liking. I'm even starting to question whether my global fund is too focused on the US and too focused on a handful of companies. But for now, I'm sticking with it. Let me know in the comments which strategy you're going for, or if you're doing something completely different. If you're looking for low-cost investing platforms, I also have links in the description below as well. Thank you for watching.